Alrighty, welcome to Real Fridays. This is great. It's actually 12:30 Eastern Standard Time for the Real Fridays. We got the three-legged stool here between Jeremy Potter and Brock Cassidy and myself.
11 times the charm.
we're,
That's what they say, Rick.
For those who are just tuning in, basically Real Fridays, as I've talked about. Can you hear me okay? Jeremy, I don't know if
we got you. Oh, really?
I
can hear you, man.
I can hear
you.
Can you hear me?
I can hear everyone.
Yeah.
You can't hear me?
We can hear you. We can all
Brock,
hear you.
why'd you say no? But
yes.
For some reason, I can't hear you. This is the craziest thing.
Great. Well, we're going to talk over you.
Yeah, that's perfect.
And that way it'll be great for the audience.
This is the weirdest thing. I cannot. I'm having now the issue is on my
end. It's
end.
Weird Fridays here. Weird Fridays here in December, Brock. Do we have a guest? I thought we had a guest today. Didn't you prepare?
So you guys
for
can hear me, and we can't.
Yes,
we can hear you,
and I can't hear you, which is
there's no guest.
Potentially a challenge.
We can hear each other.
So I just I can't believe we're having a technical difficulty, and of course it's on my end, even though just a slight delay. I apologize. Oh,
go
ahead and say something, Jeremy.
Yeah. Oh, can you hear me, Rick?
Yes, I can. Okay, good.
All right. So what we were saying is we 11 times the charm is what we were saying. And now that we're all here and we have our guest here, we can get started. So I'm glad you can hear us, Rick.
Yeah, no, I apologize.
It's your show.
It's not my show. It's our show. And no, of course, the first time that we're all together on time at 12:30, I have a technical glitch. So, but for those just tuning in, essentially Real Fridays is a conversation of mortgage, housing, and real estate experts just talking kind of free-flowing about the weekly headlines, industry rumors, which often abound, and also just technical innovations and conversations on leadership, management, capital fundraising, just different things that kind of come across the headlines that people are looking to understand. Where does this fit in the context of mortgage, housing, and real estate? Okay. Because each of us, I'm on the retail mortgage origination side, and on the kind of technical and technology advising, and helping tech companies better understand the market around them. And then of course, Jeremy's a lawyer, reputable lawyer, and an amazing innovator in the business. And I don't know why you laughed, Jeremy. I'm complimenting you.
Brock gave me the kinda. He's kind of.
Yeah, I don't know. He hasn't been a real lawyer.
He won't shut up about product and innovation for the last 5 years, so he's kind of a lawyer. But yeah.
When I met Jeremy, he was a real lawyer, but he's gotten to be less of a lawyer every day since.
Yeah.
And then Brock Cassidy is you're kind of a newer face on the scene the last couple of years, I'd say. I mean, but you're having a huge impact, I think, on tech innovation with your work at Quicken, and your work at Easy Knock afterwards, and now with your present company. So I love the fact that we generationally cover the older end with Jeremy, and then the younger end with you, Brock.
Gen X, Millennial, and Gen Z, is that what we have here? I think Brock's a Millennial.
And then Parvesh,
thank you for joining us.
Yeah, look, Polly's hot, right? And it's been a big headliner the last couple of years. And I think that there's been enough from a user end standpoint. I've always been a big fan of Optimal Blue. I've always been a user of Optimal Blue, but they've also been like the only thing in town. And I think that kind of stalled a lot of innovation within the platform. Something I could probably say and you can't, but I just think as a user of Optimal Blue for 12 years, it was always sort of a frustrating thing to do because it just lacked kind of the adaptability to specific wholesale or retail circumstances. And I met you, I think, at first when you were at Ellie Mae, and in my work with Jonathan and Joe and Sig on sort of the client acquisition side. What was your focus at Ellie Mae, Parvesh?
Yeah. Can you guys hear me?
Yeah,
we can.
Cool. Yeah, thanks for having me, Rick, and good to see you, Jeremy, and nice to meet you, Brock. Love the conversation, and these things are fun, right? In terms of real time, day-to-day conversations around what's going on in the market or technology or whatever. So thanks for having me on.
Jeremy, Parvesh texted me last night and said, can you send me some sort of, questions so I can understand? I'm like, no, there's no questions. Like we're literally having a conversation about the marketplace.
I know. I'm like, what am I being set up for here?
Right.
Yeah.
So yeah, just to answer your question, I had various roles at Ellie Mae over my tenure there, over 12 years. The opposite of innovation was, all the focus on compliance when I first joined, which was, just kind of what it had to be coming off the 2007, 2008 crisis. But technologically, it was important to the market that, that was done correctly on their behalf, so that they didn't have to spend their technology resources figuring out, compliance workflows and things like that. So that was one role. Then I involved into a business development role, which was really focused on fleshing out the partner ecosystem and, leveraging third parties to complement, the roadmap, as well as, develop tight integrations and really, what's evolved into a true platform approach. I think that's, still some stuff to finish off there, I think, on the Encompass side, but, really evolved a lot. And then moved into a corporate strategy role, and then took over sales for a couple of years. So yeah, just had a number of different hats on that side.
One of the funny things about when you joined Ellie, I was just coming out of Calyx, and one of the deciding factors, and this is, these are things I can talk about because it's been so long. Back in 2009, 2010, one of the advantages that Calyx thought was that you could type your name in the Social Security field. And I remember saying, guys, we need to tighten field level controls and permissions down. Like, the world is changing. Dodd-Frank hadn't quite sort of come together, but there's a lot of whispers. I'm from Massachusetts, and Frank was not just down the road from me, and Dodd was just south of me in Connecticut.
Yep.
And I remember doing at the New England Bankers Association doing a panel with Chris Dodd and Barney Frank about just these new regulatory changes happening and coming. And so I went back to product management at Calyx. I was like, guys, we need to tighten this stuff down, to say the least. And the conventional wisdom of the time was the more flexible, the more scalable, the more mobile.
Yeah, the freeform field is great. Yeah.
Yeah. And it was like, no, that's a strength of ours. We could type our name in the Social Security field. And I'm like, really? Is it? You really think it is?
Yeah.
And so when I left Calyx, my first client, I called Jonathan, and when I started Menlo, Jonathan, was we kind of talked, through that in ways that we can help Ellie Mae improve. This was like 2010, improve its sort of controls and structure, but then also how to sort of adopt and bring Calyx customers over to benefit from that protection.
Yeah. Well, yeah, thanks for setting it up, because that's what got me a job, was that, I guess you telling Jonathan we need to do some compliance stuff, and I got hired into compliance roles. So
yeah,
that's off to you. I guess I owe you some of my back pay here. So
don't tell him that. Don't tell him that.
Your Ellie stock.
Some Ellie stock. Yeah.
Depending upon where it was, I'll take it. But so let's now that we have sort of an introduction with Parvesh, I do want to talk about Poly and in the product and pricing market and where that tech innovation is heading. But let's just talk about, just for the moment, just any kind of weekly headlines. That's generally where we start, and then we sort of will evolve. And to you, to include you as well, Parvesh. What have you guys heard in the last week? I mean, there's been some subtle headlines, that I've noticed. I'm curious, starting with you, Brock. Let's start with you, Brock. What's come across your radar? Because you cover kind of the real estate loan officer side of the fence, with your innovation and technologies. What do you think that that's come across your purview?
Yeah, I mean, it's been a really busy week, which I haven't said in December very often. So obviously, rates have come down a good bit, below 7 for a lot of mortgage companies that we work with / in general. So that's been fun to see. Hoping for some stability there. I saw the headline that this week, I think it was a partial week. I think this headline was yesterday. Mortgage applications were up about 35 or 40% from the prior week, and a little bit more from 2 or 3 weeks ago. So that really is quite a big KPI for us because we're kind of downstream of purchase mortgage. So that's been fun and keeping us busy. But in terms of true news and headlines, I mean the agent commission lawsuits continue to spread and change and move around. I saw there's some that are Florida specific. There's a few other East Coast specific ones that are picking up. Jeremy can probably address that in more detail than me, but that matters to us in terms of our business model, but more so just in terms of like what it's going to change for the workflow between loan officers and agents, just how it's going to change the purchase and real estate world. I don't know, other than that, there's been a lot of moves around the mortgage industry, which you two probably know better than me in terms of teams moving around and some joint ventures happening, some M&A happening, it sounds like. But yeah, I've been pretty tuned into the real estate lawsuits and the commission lawsuits and what's going on with rates and mortgage applications.
You don't see that impacting you guys much, do you?
The lawsuits?
Yeah. No, but even the expansion of the lawsuits into sort of the what I call sort of the micro, like there's the main impact that hits the windshield, and then there's the splinter effect where it starts just.
Yeah, we actually we had our call with our esteemed strategic advisor Jeremy Potter on that a week or two ago, and we the conclusion that me and Audie both had. Audie was on the show a few weeks ago, our CEO co-founder, who comes from Keller Williams, who's one of the main targets of the lawsuit. So he has a really good take on it, which is in times of chaos and kind of like agents and loan officers not knowing where to go, it's going to be best to have built the best client experience. So we're kind of just staying the course on like as clients get more and more confused, as loan officers and agents get more and more confused of what the workflow is going to be, how it's going to change, what's going to happen. Like if as long as we've built the right platform for them to use, as long as we've built the right platform to give clients the best experience, we should be in really good shape. But yeah, I mean, it could undermine our kind of core business model today, which is the commission split with the platform. We get a referral fee. To local agents. So it could undermine the direct business model, but if anything, it'll probably be helpful to us.
NewZip just won the Technology and Innovation Award over at LendingTree in their LendingTree Summit a couple weeks ago, or about 3 weeks ago now. That Brock and their founder sort of made the case for it and earned, so that was kind of a cool kind of. I don't know if you were at the LendingTree Summit. I don't think probably Polly would attend that, because that's more of a sales and marketing kind of event. But
actually, we were considering going. I just got.
Oh.
I was just in my seat probably like 3 months before the decision needed to be made. So I got approached by it, but I think next year we might consider it. So
yeah,
it was cool.
Jeremy, what do you think about headlines? What came across your perspective?
I just have one quick comment on what you were just saying about this. Either the chaos or the kind of real estate mortgage relationship that's changing. I had a great conversation with Dave Savage about it on Friday, and his, he reminded me that I'm always trying to find what the end result's going to be at the beginning. I always want to be the right prediction of like, oh, here's what's going to happen. And he always reminds me, and I think it's good to mention here, that like it'll get messy before it gets kind of sorted. And so like in that messiness, there's going to be a lot of attempts in a lot of different ways to see what happens or to try different things, and there'll be winners and losers. And so I'm kind of always skipping the messiness and jumping right to, I bet here's what happens. And so it's a good reminder for me that there'll be just a lot of attempts and a lot of messiness before it kind of sorts out the role of the buyer's agent, the role of the MLO, stuff like that. The thing that I wanted to bring up from the week, just real quick, Rick, whether I always think of it this way, which is like you're interested in buying a car, and that's when you start to notice that exact car on the road all the time, but you hadn't noticed it before. You made the comment about the cost of credit pools, the cost of trigger, like some of the things that are happening around either vendor or data production costs in the system. And then this week, so that was last week's show. This week, for whatever reason, like I ended up hearing about it all the time. I hear soft pulls costing the same as hard pulls. The way that the credit bureaus or FICO are changing their economics relative to the changing market, relative to some of the things fintech has brought in that have changed that. And so, like I said, I don't know if that's a coincidence just because I started to notice it and started to focus on it because we talked about it, or because that is top of mind for almost everybody. But it seems like when an establishment service like FICO or the credit bureaus, when there's innovation or there's disruption, you know, one of the first tools in the toolkit is to push back on market dominance, push back on price. And I think a lot of lenders are constrained right now on resources and costs, as we've been talking about for months. And all of a sudden, like the establishment players are coming in and like cranking up the heat even more on ancillary data or ancillary vendor pieces. And I think that's becoming more and more a theme, particularly around credit, because it's like bigger. That whole like credit bureaus, and they're like monster companies compared to most IMBs or compared to most lenders. And so that is going to continue, I think, to be a theme in the next weeks and months, is what's going to shake out there, what's fair, and beyond what's fair, what just is the business model going to mean. So I'll leave it there, give you guys a chance.
One connected theme with what Jeremy just said that I should have mentioned, that's been a hot topic for us, because we at NewsZip, we basically work leads alongside lenders, right? And so, you know, however they're generating leads, and ultimately borrowers, you know, it can vary. But it looks like lead cost, not only are like the soft pull costs going up and some of the data costs going up, but lead costs look like they're going to go up a ton in the beginning of 2024 with some of the TCPA changes that are coming, which basically, as far as I understand it, are going to boil down to one lead can only be sold to one lender. So, you know, instead of selling leads to 4, 5, 6, 20 lenders, you're going to sell it to one for, I don't know, twice as much, 3 times as much.
Is that official? Is that yes.
Well, there's different interpretations, but some of the big marketplaces that we work closely with seem to be basically boiling it down to every lead is going to be every lead that comes in through, you know, that doesn't opt in to be sold to multiple lenders, I guess I'll put it that way, can only be sold to one. Seems to be the interpretation. Yeah.
Parvesh, I have a question or a comment that's a segue to your observations and getting into talking to you. But there was actually a mortgage broker whose differentiator, their role was to have like a nice digital application at the beginning. That was kind of what they built and why they wanted to become a mortgage broker. And hearing from them, they said that they think they could make more money selling pre-approved purchase leads than actually originating through their wholesale partners. And that would be a kind of strange shift, right? Hey, I got this digital application. That's where I put a lot of my investment over the last 3 years. And now I'm suddenly realizing I got all these pre-approved purchase leads that are more valuable than doing the loan.
Than doing the loan themselves. Yeah.
Yeah. Because the time.
So the concept there would be, you know, take the tech, they get the engagement, they don't even try to close the loan. But I guess in this new world that Brock was talking about, it's only a one-to-one situation, right?
Yeah,
so
that could change.
By virtue of that, that's got to be functionally less than what they'd make.
Yeah,
right? Agreed. In that world, they probably wouldn't be as excited. Correct.
They wouldn't be as excited. Yeah, that's right.
Yeah.
I think that might be an opportunistic short-term kind of play, because the demand for qualified leads is so high right now because of the way pipelines are today. But I think that's gonna moderate and correct a bit.
Yeah, I mean, on that note, like to what Brock was saying, just in the last week, I was on site with a top 10 lender yesterday, and they said, yeah, like the broker activity really picked up dramatically. Just in the past week, given the rates, came down. So across retail and broker, I think, the stabilization of rates would be the headline. The other headline that I'd throw in there is, it's tacking on to the dismay that everyone has, but, I think more consolidation is happening in the next 30 days. I think it's going to actually happen the next 90 days. I think we're all tuned to that on that side. But the interesting kind of counterpart, and this is kind of like the mortgage cyclicality or almost like counter intuitive part of, the cycles. And this is always what happens, right? Is like, we make a bunch of money, or lenders make a bunch of money. And money's really easy to come by. If you want to do capital raises or reinvestments or whatever. But then, when things come down, then money's not easy to come by. But what was kind of interesting that I was seeing this week is that the ones that really understand the mortgage industry, that have the capital, are starting to come back into it, like the newcos, right? Like the net news. So people are going to be exiting and leaving because they didn't properly retrench, in the past 12 months and reallocate cost structure and things like that. The general investment community is not going to come in because they don't understand mortgage. But I am seeing the fringe guys that are lifelong mortgage investors are starting to think about, and it's correct, right? Like we've seen this. Now's the time you start the company. You start with the new tech stack. You start with a new experience, more efficiencies, better profitability structure, all that kind of stuff. So that when it does come back, which won't be for, probably another year, they have everything humming, and then that's where they're going to be able to leapfrog, ahead. So that was kind of I was at a lunch yesterday, and then I heard it a couple other times earlier in the week. And so I don't know. So I think that was kind of my interesting news for the week of despite people exiting, there's the lifetime, mortgage people that I think are starting to think about this is the time that you come in. So.
And where does Poly's role come into that? I mean, obviously Poly, like any product and pricing tool, it becomes an effective cost containment, asset, right? Where you can look at how, what the overall concessions, because concessions are often the lowest hanging fruit to be able to control and manage and to kind of drive. But are there other tools and analytics that enables a lender to just exercise more control of their pricing strategy that would be different or more innovative, do you think? Or
yeah, I mean, I think there's a number of things there that are the specifics of, what a more advanced mortgage tool can do. And then it's kind of the generalist stuff that I think attaches to what Jeremy and Brock were talking about, just the macro view on what does it mean for a lender to start to upgrade their tech and be more proficient. I think from, the specifics, yes, when you think about a whole bunch of automation around, pricing engines, being able to do lock automation and exception handling to what you were saying, Rick, and having documentation around those exceptions so that you're not, spinning up other resources to, manage those document repositories. And then you have it in an email and it's analog and blah, blah, blah. All that automation that needs to happen around, loan officer engagement all the way through to close regarding, a lock is something that, I think we're seeing, we specifically, but I think are providing a lot of lift, but that's where lenders are looking for lift. I think kind of in the macro world, and this is kind of the evolution of technology. And I think Jeremy was talking to it earlier where, you have incumbents, they lean in on kind of the legacy tech, but even, and you mentioned it earlier, Rick, OB has been struggling on that side because, yeah, they are a 20-year-old technology.
Yeah.
Right? I think
and mortgage pricing systems wasn't any better. It was probably worse when Ellie bought MPS and
I have no comment on that. So
well, I'm just saying that they're really, I mean, it was the best of the worst, basically.
Yeah,
OB has been for the longest time, right?
Sure. But so, yeah, exactly. So like those technologies, exactly, they were solving the problem for that time, which was 15, 20 plus years ago. Obviously, technology's evolved. And so I think, when you think about starting with a fresh tech stack and then applying like the domain expertise that you need of actually knowing the problems that you need to solve inside the mortgage industry, is where like the new lenders, the smart ones are going to refresh their tech. The new ones have an opportunity to start new and then, go from there. And so I think, like a lot of innovation that Brock and Jeremy were talking about has been around the customer experience, the borrower experience, the point of sale system, all those types of things. And not a lot of attention was really paid on the back end, which was always kind of surprising to me, and like a place that I was always really interested in, which was like the secondary market and the collaboration between the primary market and the secondary market, and execution of that, not only from a price standpoint but from a loan fulfillment standpoint, around like all the friction that was caused with transferring documents and data. And there's stipulations that would come about, and it's like, well, why? Like, why do they not have like transparency throughout the whole thing? And so I think the thing that is exciting about Poly is just that is a focus, right? The back end technology, which to me is like the most important part, because that's where the money is, right? Like the money is in your margin management. It's in getting loan products out to be reactive to the market. To be able to say, okay, well, I got a new loan product. How am I going to compete with it and get it out to market with the proper margin profile on it, so that my loan officers can consume it and get it to a borrower, and then, win that business. And so that's what I'm really like I'm seeing. And that's what I'm excited about, is that, marrying up like that borrower quote unquote experience where it's a great UI and they don't have to, fields are pre-populated and things like that, with like a loan product that actually gets them a better price and more money in their pocket. And then you think about that execution all the way to the secondary market, where you can kind of start to unify, price, lock, the closing of the loan and then the trading of the loan. Those are all the things that I think are starting to kind of like come together now. In the tech stack.
Parvesh, Rick, I have to drop in a few minutes, so I want to jump in real quick, because Parvesh, you just nailed it. Like when I was in the capital markets at Rocket, one of the things that struck me was, hedging tends to be like this quiet piece that you have to do, and it doesn't get a lot of attention, even within the capital markets group sometimes. But the reality is, when you are on it from a data perspective and a market perspective, and you're daily in there, just like your pricing meeting, every morning you're in, your hedge, there's millions of dollars of savings a year in there. You can actually move the needle for a couple $1,000,000 by being really diligent and disciplined around your data and around your practice. And I think you're exactly right to say, I think a bunch of companies haven't spent a lot of time there focused on that or realizing that. But then I think the other thing I wanted to just mention was your comment. And when I left Rocket, I went to a company called Stavvy about, that digital closing experience and that type of thing. And the one thing I was struck by was like, we are constantly verifying and reconstituting data sets and then breaking them apart and then re-verifying and reconstituting them again somewhere else and then doing it again. And I know everybody talks about this, the checkers checking the checkers, but they don't really go down the next level and really talk about what that means on a data management level, that once you're actually able to say, this data is the legal, what I used to say about the closing was like, the data doesn't get more perfect than that, right? you're going to get as close to right and as close to perfect. And we all make mistakes, and it's a risk business. But like the closing is as close to that data comes as being done, as being baked. And then why would you break it apart? Why would you change that? If you can keep that together, as you said, from your production and origination system through closing into the capital markets and then delivered to whomever the ultimate investors end up being, however many times it gets bought, sold, or repackaged, and we know it has multiple assets, the servicing asset as well as the underlying loan asset. The more consistent you can keep that, there's money there. There's revenue there. There's profitability there.
There's real money, yeah.
Yeah, it might not. Yeah, I think it's one of the things that needs more attention.
One of the questions I have for you, Parvesh, is that oftentimes like secondary is a function of the expert that's really driving the desk and in driving capital market strategy. How do you automate that? How do you basically apply some just inputs from an automation standpoint? So it's more of an I hate using the term AI because there's like there's real AI technology out there. I was just talking to a company out in Silicon Valley that just raised $40 million for the way in which they optimize the way they organize. There's a whole LLM sort of technology around it that they're able to sort of increase the probability of accuracy in how they take the data in and how they present data out, either to ops or to consumers. And their question to me was, what's the status of AI in the mortgage business? And I said, well, it's difficult to tell between the marketing headlines on quote unquote AI all over the place versus what's true AI and yielding real, reliable, repeatable.
So
how do we get rid of the dependency on the smartest guy in the room? I'm the capital markets guy. Onto more where the tool is providing market guidance and it's seeing the market adjust and it's actually adjusting these strategies for the enterprise.
Yeah, and there's a number of things there, and it's all about not necessarily replacing the cap markets guy, but like enabling them to operate at a higher velocity and with more information at their fingertips, to make decisions. And the thing that Jeremy said, like, to me, it actually starts foundationally with like normalized data. And so you have to normalize that across origination and trading and hedging and secondary market in order for that cap markets person to really like garner those insights. And then once you have that, then you need a broad set of data, right? Then you need the aggregation of what's happening in the market in order to, put those insights forward. And then you need AI. Like there's nothing else to call it right now. I mean, there's different forms of AI, and there's rules-based systems, and it's probably a combination of the two somewhere in there. But then you take all of that normalized data and large set of aggregated data, and then you're applying things that could like increase propensity models, pull-through models, all those kinds of things that basically tell the cap markets person where they sit at any given moment, in either pre-lock, lock, funded, ready to sell, wherever they're at, on that side. So I think AI is real in this world. I think that when you start to apply it to like the different, areas that you can apply it to in mortgage, whether it's like, underwriting, rule sets on underwriting, whether it's, consumer engagement, whether it's capital market stuff that I was just talking about, I think it lives. But yeah, I'm not trying to give away too much right now, but there's a lot of opportunity there to leverage that and pull it in. So
guys, I got to step out. Have a good conversation. Thanks for joining us, Parvesh. Talk to you soon.
Sure.
I just think it'd be cool for a product and pricing engine to actually adjust the margin strategy for the lender, without necessarily, because you are sort of beholden to. It's almost like it'd be great to provide an origination tool to loan officers that creates more of a where it's not quite as subject to how much the loan officer knows about product. That the solution says, hey, given these inputs, here are the products that you need to sort of funnel them through. Right now, if you're not an expert in non-QM, you're not going to sell non-QM, right? And it puts the consumer at a distinct disadvantage because you're limited to based on what the realtor saying to the loan officer, what options do you have for my person? And
that's right.
Like, look, I'm
even
a VA.
outside of
All I know is VA.
profitability and hedging and all that stuff, it's getting the loan officer to know what their options are. And we've all seen it, right? Like where lenders, a loan officer inside of a lender basically says, they're a top performer. They go to the cap markets guy and they're like, I need this product in, Hoboken, New Jersey or whatever. And like, I need this non-QM product and blah. And because he's a top producer, the capital markets guy is like forced to do it, puts it on the books. And it's just that one loan officer now selling that product because the other ones just don't even really know about it. They don't know how to sell it, or anything like that. And I think to the extent that, this word gets used a lot now, I think in our industry, but like, democratize that information out to other loan officers of knowing, God, I go to these 3 default products every single time. I have these 5 others that I could put in front of them. And maybe even maybe even the bank wants to push those in front of them because they're more profitable, on that side. So all those things I think are the right things to be thinking about that you're talking about, Rick.
Yeah, I know the capital market side is kind of deeper in the process than generally where Brock, where you reside. I'm just curious, like, is there a real estate play ever in product and pricing? I mean, is there a way where the value is so strong, like the value emanates from sort of the pricing margin product strategy that somehow it somehow affects the realtor? Or is that just too much of a stretch and outside of the lane of a PPE?
I don't think it's too much of a stretch, but I don't think it's like the everyday occurrence either. I think it's like somewhere in the middle. I think it's like plausible, but doesn't really happen. One thing that we do at NewZip and plenty of lenders do it directly that own their own real estate companies, is if you close with both the lender and the partner, the integrated real estate solution, whether that's an actual owned real estate company or a partner or whatever, there can definitely be real estate side concessions. That's how we do it, which can be used for rate buy downs and things like that because it's available at the closing table, a credit at closing. So in that way, you can take a real estate concession and bring it into products and pricing. Well, not really product, but bring it into pricing a little bit. So that's one kind. It's kind of a stretch, but kind of one way it connects. But other than that, I mean, listing agents definitely look at what product is selected and things like that. Jeremy and I always debate whether listing agents should or shouldn't get all the details about the product and the details of a loan, but the fact is they do. So I think it kind of, I think it's a little bit of a stretch, but there's like edge cases where the two connect.
I mean, I wonder if so, one of the struggles that real estate agents have right now is, because rates are so high, it's hard to get the borrowers off the dime. And I guess if I just think it through, like the real estate agents go to their trusted mortgage advisor to be like, hey, like what's going on? And the mortgage, lender is probably, rightfully pushing in front of them or jumping and being like, hey, go, it's time to buy. It's time to buy. I wonder if there's a world like where it's like, I'm just thinking out loud here because we're on this, this session that I figured that's what we're supposed to do, right, Rick? Is if like a realtor had like a real-time application where it was part of like their, daily view where it starts to like set alerts, like, rates just dropped to XYZ rate.
Yeah.
Now's the time that these 7 borrowers that you had, push them into finding a property. Like you can make it all connect, right? And I'm sure I'm not like thinking anything that no one's not thought about before, but like if you connected that then to like a real estate like transaction where it's like, okay, and then it's like an affordability thing, right? Okay, it's dropped to 7. You already have like some of these guys pre-qualified.
Yeah.
Now you show 7 properties that they could start buying right now. Like that's the connection, right?
Well, that would be an interesting connection. Like, let's say New Zip has this relationship with Poly, and then
is that what this is? You're trying to broker a relationship right now?
No. But I'm just sort of innovating on the spot, right? Where New Zip takes, and I'm a realtor. I upload all my listings into the platform. You're giving me as a realtor, let's say, updates on the market, on whether that's a good time, a time to hold, a time to wait, maybe even a forecast the next 30 to 45 days. There's kind of a predictability curve there to say, don't wait. This is why. It might be good for the consumer, or it's likely the consumer may wait, and these are the reasons. But in light of the listings I have, in light of the market adjustments, this is how much the consumer could save.
Yeah.
Right. And so it kind of creates an educated urgency that I, as a loan officer, as a realtor, I don't have to understand the whole thing. All you need to understand is if you buy now, you could save on average $180 a month for the next 30 years.
And here's 5 houses, around the corner.
5 houses of all my listings that fit.
Yeah. That's that a part of what at the Lending Tree innovation pitch contest thing that we won. One of the things that we pitched was not exactly what you said, but kind of a version of that. We're calling it, this is still in beta, I don't know if this is the right name, but we're calling it a home trajectory score. It's basically like buyers like you are probably going to buy a home like this at this time, right? It's probably going to take you 3 months, probably a home like that. And so basically it's some AI, mainly like kind of like lookalike audiences of like, people like you with a financial position like you in a market like you are kind of like doing these sorts of activities. It's taking them 4 months. They're having to make 3 offers and they're ultimately buying a home like this. Right. And so we're figuring out the right ways to package that. Not all of that's like good marketing and sales. People don't always want to know all that, but it's kind of, but it's interesting to know that we are starting to be able to bucket it like that, the financial details plus like the real estate market details, and turn it into something personalized to say, we think it's going to take you 5 months and 5 offers to get a $700,000 house in in your market or whatever.
So what do you think? What do you think, Parvesh? Think you could do that?
I told you someone already thought of it.
Not all of it.
We think about a lot of things, and nothing ever really gets delivered to market because I don't know of a single tool that actually does exactly that. I think, but in what you're presenting in that home trajectory score, it's lacking real pricing data, like real aggregate pricing data in that market. Because someone like Poly can say, hey, in your market, here's the average rate, because it'll differ, right? And they could sample, 50 lenders in that market to create a MSA margin score or kind of an average plus or minus. And you could, and then that data becomes a real data that you then can say, in light of this purchase price with this amount down plus minus, 5, 10, 15, 20, 0, this is where you're going to be at, and this is how much you could save. And the probability of savings is this, or probability of losses is that for inaction.
Yeah.
And as a realtor, I use that as great information to educate my consumer.
Yeah. So we should talk, Brock.
Yeah. We don't have that part, so let's get it.
This LinkedIn person who's watching, Amy. Thank you, Amy. Dynamic models that consider risk in real time having improved over the years and will surely continue to improve with the latest AI ML, but the risk policy would need to keep pace with the tech changes to ensure appropriate risk management. This is a really, really good comment.
The AI ML stuff is just now getting, incorporated in a lot of the PEs as well. So it's a very appropriate comment.
And I'm assuming you do real time like fair lending sort of analyses on where a lender across like a multi-state footprint is scoring or is faring?
So in our, we're rolling out. I think we already announced it. Yeah. Okay. So yeah, we're rolling.
This is the time for real. There's Real Fridays for real announcements.
I gotta be careful, man.
A global, worldwide announcement from Poly is what now?
So we're rolling out a competitive analytics solution in Q1 that contemplates all those kinds of things, at a very granular detail, I think, beyond than what's been seen before. So once that comes into market, yeah, I think we'll be excited to kind of share the details around that.
Let's do it. And I think we should do a demonstration here and how a lender can actually protect themselves for sure. And look, I know Mortgage Collaborative and a number of these other platforms or organizations do share pricing data, but it's very manual. Like they'll pull data from various lenders, and then they create kind of like, this is where you're at and this is where your competition's at, within various markets. So you can at least see, are you high, cheap, are you the cheapest one in the block, the most expensive, or right in the middle? And I've always priced things out to be in the middle to the high end, knowing that you can always sort of manage things through by concession. But and then just lastly, do you have any integration to the economics to the firm? Do you pipe in with A&B and kind of say, like, look, if this is what this means by not just on a per loan basis, but as an organization, how much money you're making or losing, or is that just a separate input into the accounting platform?
No, we do have that, like, at the aggregate level as well as the loan officer level, where you're kind of able to look, at the loan aggregate, in the money at any particular time. And then there's some things that we're continuing to build out that you need some functions that tell you, real time profitability along the way. But in terms of like loan officer, per loan officer profit level, things like that, those are things that we have today. I apologize, Rick. I gotta jump, man. But it's been nice meeting you, Brock, and Rick. Let's connect later so we can catch up.
Yeah, no, I absolutely look forward to it. I'm going to put your contact information here so that way those who watch this video, later on can get in contact with you. Yeah, well, it's on your email signature, so I figured it was safe to be able to have this live in perpetuity on LinkedIn, Facebook, and YouTube. So
that works, man.
Hey, Parvesh, I appreciate your expertise. You're a leader in the business and a thought leader at that. So I really look forward to working with you in the future and watching what Poly does.
Yeah, I appreciate it. Have a good one.
Hey, Brock. So sorry that you didn't get to sort of jump in. I'm a big fan of your platform in a big way.
No, that was good. I didn't know. I told you before. I really did not know a whole lot about Poly, and it'll be fun to connect with them. It makes a ton of sense that pricing and product data is getting, more flexible and more integrated, and
look, if I'm a new Zip and I'm trying to create as much possible value as I can to both loan officers as well as realtors, I think it makes a lot of sense to be able to have some kind of like market analytics and like rate analytic feed into it, because it just becomes it's data. So it's not, and a company like Poly would be a great partner, because they've raised a ton of money and they have a ton of traction in the business. And I think being able to extend their value to the very front end of the origination loan realtor connection, all the way back to capital markets, also brings new Zip into capital markets by extension. So it would be a really interesting opportunity in potential partnership. Yeah,
cool. Glad to meet Parvesh.
No, man, I appreciate you very much. I look forward to more conversations here on Real Fridays and talking to you about next. We're gonna be meeting next Friday, and then we'll take Christmas off, I'm assuming.
Yeah, I think so. By the way, are you getting out to the MBA IMB conference in January, or what?
Yeah, 100%. Yeah, 100%.
Okay.
That's in New Orleans, right?
Yeah. I went last year. It was really good. And it's really where I connected with Audie and ended up working at Newsip. So that was a good conference for me.
No, that's fantastic. Yeah, absolutely. We'll definitely have to coordinate, the travel details, but I plan on being in New Orleans for that. I think I'm a big supporter of the NBA and the work that they're doing, and I think it'll be a good, conference for, networking with other INBs.
Yeah, it's the conference circuit's kind of shut down for a little while, but that'll be a good one in January.
Yeah,
cool.
Good deal. Well, good to see you, partner, and I look forward to talking to you again soon.
Sounds good. See you, Roque.
Take care, bro.